You had great earnings, great economic data, particularly here in the US, but the market simply hasn't been prepared to put a value on that. And the reason they haven't been prepared to put a value on it is because of uncertainty about future growth and future earnings. Trade, one important part of that, but also it's about uncertainty of the implications of fiscal policy here in the US, uncertainty about the implications of the higher oil price, and uncertainty about the future of Europe, all of which contributing to a market that's in a range, but still supported by those positive fundamentals.
When you say uncertain about the price, are you talking about what multiple to assign to earnings?
That's exactly right. So you've seen earnings pick up, but the market's not been prepared to put a high multiple on those current earnings. So you've seen valuations steadily improve this year, particularly in the US, but also in the rest of the world. The market's placing a higher risk premium essentially on current earnings as that uncertainty rises.
Do you agree with the multiple that the market has assigned, or do you see value here, or would you sell because you think it's still too expensive?
So at the beginning of this year, many people were looking at the US market in particular and felt it was expensive. When you look at the market now, it's really notable that it's trading actually slightly below its long-term average on forward earnings.
What's that number?
We think it's fair. It's trading around 16 times earnings. That given where the level of interest rates are, particularly long interest rates are, that looks fair to us. But I think one important thing has changed going forward, which is that when we look at what's going to drive returns, it seems to us that unlike last year, returns are going to be driven by earnings growth and going to be driven by carry or yield, and they're not going to be driven by the market putting higher and higher multiples on stocks.
What do you think it'll take for this stalemate to be broken, if you want to call it that, in terms of the markets kind of sticking with this valuation despite the fact that earnings are growing so fast? Some are saying that the Fed has to blink at some point, right? They have to move away from this idea of 2 more rate hikes this year, something like that.
I think the Fed blinking is very unlikely. The Fed's on a path now where they've indicated steady 1/4 point quarter going forward. And actually, I think the market is very at ease with that level of tightening. We've seen that the US economy has been able to withstand steady interest rate hikes. So when I think about what causes this market to break higher, well, I'll start with earnings growth. I think we'll need to see the market becoming more confident that earnings growth is not just going to be strong this year, but also next year. I think the market is certainly looking for some easing in those trade tensions and a stability in long-term interest rates, which we're starting to see. That if we can see bond yields settle around the 3% level, I think investors will be much more confident about putting some of that cash back to work.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.